Thank you, Helen. Good morning, everybody. Can you hear me okay in the back? Yes, thumbs up. My personal favourite there is meh. Not much positivity coming out there. So let's try and change something like that. So I'm going to start with a bit of good news to see if we can get this a bit more positive. When Helen starts our partners meeting, she gives the group an opportunity to share some good news. So I thought I'd share some good news with you to start with, or at least a little bit of good news. And that's starting with inheritance tax. So after last year's budget, there was two pretty fundamental changes that came out that left people pretty battered. So the good news this time around was that there wasn't really any changes to IHT, at least any adverse changes. So just a quick recap. There was no changes to the rate, that's still 40%. There was no changes to the tax-free allowance, that nil rate band, that's still at 325, albeit it's frozen until 2031 now. The residence nil rate band, again, that stays at 175. And the gifting time period, there were some rumours that that might have been pushed 10 years, but that stayed at 7. So you gift an asset, as long as you survive 7 years, it's out of your estate. So just quickly recapping on what one of those announcements last year was, and that was the reform to the agricultural and business inheritance tax relief. So currently, as we stand or sit today, no matter what value your business or your farm is, it should get 100% relief from inheritance tax. Now, in April next year, this is changing, and only the first £1 million of a trading business or a farm is going to qualify for 100% protection. Anything above £1 million effectively only going to get 50% relief before it's taxed at 40%. So they're going to tax that balance at an effective rate of 20%. So there's a very quick recap. You've got a £5 million trading business or a £5 million farm. First £1 million of value is protected still, but that balance of £4 million is effectively taxed at 20%. Now, the change that we did see in last week's budget was around that £1 million allowance. Sadly, it wasn't increased to 5 million, which there was potentially some rumours about it might be increased. That didn't. That was still staying at £1 million. But the slight good news is that it's now transferable between spouses. So when spouses have various allowances, so everybody has that 320 nil rate band, that 175 residence nil rate band, and they've got this £1 million APR BPR allowance. If one spouse dies, and let's say they leave everything to the surviving spouse, they don't use their allowances, so they can go over to the estate of the surviving spouse. Now, the original proposal was that that £1 million allowance had to be used by that original spouse. If they didn't, it was wasted. So that surviving spouse would only have £2 million of allowances to play going forward. The million nil rate bands combined, and then the million business. So the good news that we got was that it is going to be transferable. So when the one spouse dies, now all three allowances will go over, and therefore a surviving spouse could have up to £3 million of allowances in their estate. But this is probably only going to benefit smaller businesses, smaller farms, and we're still going to need to do some planning. We're probably still going to need to look at succession, passing things down to the next generation, taking that value and spreading it around the family. One of the reasons is to do with that residence nil rate band, so that 175,000, which becomes 350 if you leave it to a surviving spouse. So that 350 in kind of tax terms, that's worth 140,000. 40% inheritance tax, that's a tax savings for the estate of 140,000. The problem we have here with transferring these bands over and leaving everything to the surviving spouse on first death with the residence nil rate band is that it's tapered if an estate goes over 2 million. So in the chart here, if an estate is £2 million, you get the full benefit of that 350,000 if you've had it left from a surviving deceased spouse. But the larger that estate gets, that nil rate band is tapered. And if the surviving spouse has an estate worth over 2.7 million, it's tapered in full. So whilst having this ability to transfer the unused allowance from one spouse to another is kind of good news, if that spouse has an estate of 3 million anyway, they're going to start getting tapered on this residence nil rate band, and they're going to lose that 140,000 tax savings. So we're still probably going to have to look at where we're leaving assets to. We're still probably going to have to look passing things down to the next generation, either earlier in lifetime, maybe even to a trust fund. So it gives us a bit more flexibility, but still need to do some planning. Okay, enough of the good news. Let's get into some bad news, shall we? And the bad news is we're all going to pay more tax. So in the run-up to the budget, there was speculation that the Chancellor might just put income tax up by 2% across the board, raise the tax deficit that she needs to, but obviously that would mean breaking a key manifesto promise. So instead of getting one large tax measure, we ended up with what this picture is meant to show is a smorgasbord of tax measures. And we ended up with about 8 or 9 smaller tax rises than one big one. So collectively, we've got 26 billion of tax being raised, but by a number of different measures. And that's what I'll be going through, majority of those this morning. Now, whilst the Chancellor didn't just put income tax up across the board, some people still believe that she did break a promise. And that is because she throws the personal tax thresholds again for a further 3 years. So the personal allowance, we're going to be stuck with 12,570 for the next 3 years, high rate threshold at 50,000, and the additional top rate threshold at 125,000. They're all frozen for another 3 years till 2031. And as we know, when we freeze those thresholds, we drag more people into the tax net, and that generates more tax receipts for the government. It's a chart from the OBR. So the yellow bars signify new people that are brought into the tax net. So in 23-24, it's roughly around 2.5 million, but by 2031, there'll be just over 5 million people that have been dragged into the tax net as a result of freezing these thresholds. The green is people who are being brought into high rate that previously weren't, and the purple is the additional rate. And the blue line there, as you can see, is the additional tax receipts that the government gets as a result of this, cumulative. And you can see the effect there of effectively not raising income tax directly, but freezing the thresholds. The OBR did some calculations, and they said if the thresholds weren't frozen and they were allowed to increase with inflation, by 2031, the personal allowance, that tax-free amount that we all get, that would be somewhere in the region of 17,000. And the higher rate threshold, where we start paying 40% income tax, that would probably be somewhere in the region of £70,000. But obviously they're still frozen, so we're back at 12,50. Now, one group of people that might be affected by the fiscal drag is state pensioners. So we know that state pension grows each year under the triple lock promise, and that's the higher of 2.5% CPI inflation or earnings growth. And we know that last year earnings growth was the higher of the three, and that was 4.8%. So next year's basic state or new state pension is going to be 12,547, so just shy of the personal allowance, about £23 short of the personal allowance. So in the graph here, we've got the green line that's stagnated, and the personal allowance, that's that 12,570, that's the tax-free threshold, and the red bars are the growth in the basic new state pension. So as we can see, in April 26, that's basically just under or just over £20 shy of the personal allowance. And then in April 27, assuming they keep triple lock, even if it increases by the minimum 2.5%, that will take the new state pension above the personal allowance for the very first time, potentially bringing some pensioners into the tax net. Now, the government have said that as long as a pensioner's sole income is from the basic or new state pension, as long as it's their sole income, nothing else, they won't have to pay any tax as a result of going over that personal allowance threshold. And Rachel Rees has been quizzed on that since the budget, and she's confirmed, I think, that that will apply at least until 2031. So just to kind of summarise that section, of the 26 billion that she has raised, roughly a third of that is coming from the freezing of the personal tax thresholds. Now, whilst the government promised not to raise taxes for working people, they obviously didn't make that same promise when it comes to non-working people. And therefore, savings and investments, that's where they went after. So, from April next year, dividend income is being increased by 2%. So the basic rate of dividend tax is going from 8.75 to 10.75, and the higher rate dividend tax is going from 33.75 to 35.75. The additional rate tax, which is for people who earn over the 125, that's not changing. That's staying as 89. I hear anecdotally that the reason for this is when the government and the Treasury are looking to introduce a certain tax, they'll get feedback from industry experts. And the feedback that they had is if they raised the additional rate on the dividends for a certain grouping of people, mainly people in the City of London, it wouldn't go down very well. So apparently, she has kept it for that reason. The dividend allowance, that's staying at £500, so that's purely an administrative kind of measure. That's saying anyone can earn up to £500 of dividends and they won't pay income tax on it. You've got thousands of people, mainly pensioners, who have got some shares and they're paying a couple £100 of dividend a year. To have them fill out a tax return, pay income tax on those dividends is not what the government wants. So they've kept that £500 kind of de minimis threshold in place. Now, if you're in control of when you can receive or take dividends, if you're a company owner, then you're probably going to want to accelerate some of your dividends forward to the current tax year that we stand now to save that 2% from next year. The government estimate £0.3 billion in taxes will be accelerated into the current 25-26 tax year. And S455 tax, Section 455 tax, that will go up too. So this is when a company loans money to a shareholder rather than paying them a dividend. If that loan isn't repaid within 9 months of the company's year end, HMRC will levy a temporary tax charge on the company until such a time as the shareholder has repaid that loan to the company. Now that Section 455 tax is always aligned with the higher rate dividend tax, so that too will be going up to 35.75 from next April. Now, with the increase in the dividend tax rates, that will raise further questions as to whether it's more tax efficient to receive a dividend or to receive salary. So if you're just looking at the income tax side of things, from a personal point of view, it's more tax efficient to receive a dividend than salary, because income tax at 10 rather than 20 or 35 rather than 40 is better, and there's no national insurance on dividend income either. Where it gets a little interesting is when you look at the corporation tax relief for salary. So dividends are paid out of post-tax profits, so there's no tax relief, but salary is paid out of pre-tax profits, so the company gets to deduct that salary off its tax bill. So if you own your own company, sole shareholder, sole direct, if you would look at your own personal tax position and the companies together as one, then the numbers are suggesting it's probably more tax efficient to pay a salary, because whilst you will pay more income tax personally by taking a salary, the company will save more tax by doing so, by paying that tax deductible salary, and so the net effect is that there would be a saving. Now, it all depends on personal circumstances. If there's a husband and wife and you've got two people, that might change things. If you've got other income elsewhere, again, that might change things. So just looking at solely as a kind of sole shareholder director company, it may be with these increased dividend taxes that it's going to be more efficient to maybe switch your remuneration tactic and maybe start drawing salary. So the message here is just review your remuneration strategy. because it may be that we might need to move over from dividend to salary. ISAs, we saw that the limit on subscribing into cash ISAs has reduced down to £12,000, and that's going to be from April 27. So the overall subscription limit into an ISA is staying as it is at 20,000, but the amount that you can put into a cash is just dropping to 12. It doesn't impact over 65s. They can still put the full 20,000 into cash ISA. So the government are obviously aiming to encourage people to put more into stocks and shares. So somebody could put the full 20,000 into stocks and shares. They could split it half and half and do 10,000 in each. But the most they can do into cash ISA is going to be 12,000. As I say, with the hope that that 8,000 is then put into stocks and shares. Now, not everyone will want to put the excess into stocks and shares. They might want to keep it in cash. And if they do, they'll have to put it in a standard bank account, savings account outside of a pension wrapper. And therefore, if they do, then the savings rate is also going up by 2% from April 27. So bank interest effectively will be taxed at 22%, 42% and 47% from April 27. Again, the savings allowance has been left unchanged. So the savings allowance is the amount of bank interest effectively that you can earn tax-free. If you're a basic rate taxpayer, you get the £1,000. And if you're a high rate taxpayer, it drops to £500. So putting that into a couple of examples, if we use an interest rate, say 4%, you can have £25,000 in a bank at 4%, earning £1,000 interest, and you wouldn't pay any income tax because of the personal savings allowance. And if you're higher rate, you only get half that. You only get £500 tax-free, so you could only have £12,500 in a savings account. So if you are maxing out on your 12,000 cash ISA and you are having to go into a standard savings account, there is still some leeway before you will end up paying those 22, 42 and 47% income tax rates. The other allowance that remained unchanged is the starting rate band. That has remained at 5,000. Now the starting rate band is available for individuals who have got non-savings income less than 17,570. So that's the 12,570 personal allowance plus this 5,000. So if you've got non-savings income, so that's employment, self-employment, pensions and property income, if that's below 17,570, then you can get up to £5,000 tax-free. So using the example of a retired pensioner, we saw earlier that the new state pension is going to be 12,547 from April next year. So say someone's on that new basic state pension at 12,547, they can have up to £5,000 of interest and still be completely tax-free. So they won't be hit by that 22% increase. So that could be, again, at 4% interest rates, that could be worth £125,000 in a standard savings account, not in an ISA, generating £5,000 of bank interest, and that can still be tax-free. So one area where this could work quite neatly is with company owners, and in particular company owners that have got a director's loan account. So if they've lent money to the company, they can charge interest on that loan. So in the same way that if that company went to a bank and borrowed money, the bank would charge them interest on that loan. If you have lent money to your company, you too can also charge interest on that loan. So let's say that the loan is £100,000. That might be that you've made lump sum payments to the company as a loan, or it could be that it's just naturally built up. You've declared salary and dividends over the years and you haven't extracted all of that cash out of the company. You've kept it in there for working capital purposes, and that's slowly built up over the years. So now you've got what they call a director's loan account. Let's say it's 100,000. If you were to charge, say, 6% interest, and I'm kind of saying 6% maybe because it's unsecured borrowing, you could receive £6,000 of interest. Let's say you decide to take a salary and you equal that 12,570, which is the personal allowance. You could withdraw 18,570 from your company, and that would be completely tax-free. So the 12,570 of salary is covered by your personal allowance of 12,570. You've got your 6,000 of interest. You've got your 5,000 of that is tax-free from the starting round, and then the 1,000 is left over from that personal savings allowance, assuming you are a basic rate taxpayer if you keep your income up to that 50,000 mark. So you could then top up with dividends, which will now be at 10.75, up to around about that 50,000 higher rate threshold. So that could be a neat way of getting 18.5 grand out of the company completely tax-free. And again, it goes back to that salary versus dividend, and there's no one size fits all. You kind of got to look at your personal circumstances. So in this particular example, someone's got a loan account that they could charge interest on. So that might mean this is the way to go as opposed to taking higher salary. So it's all personal circumstances. So you need to look at both yours and your spouse's. Have you got loan accounts, and have you got any other personal income? And it needs a whole kind of review. So it's no one size fits all. But this is potentially still a neat way of extracting cash out of the company completely tax-free. Okay, property. Just to complete the set, so we had 2% income tax rise on dividend income, 2% on savings income, and now we're getting 2% on property income. So we're going to see 22%, 42%, and 47% from April 27. Why April 27 and not next year, like the dividend raises? These guys hold the answer. Anybody know who that is? Nobody? Trip? I'm hoping I've got the right picture now. It's meant to be New Order. And the reason why they hold the key must be too young or too old for people here. The reason why New Order is the answer is because we're going to have New Order how we set off that personal allowance. So at the minute when you do an income tax computation, we've got three categories basically. So we have non-savings, savings and dividends. So non-savings is the employment, self-employment, property and pensions. Now they want to tax property at a different rate. It cannot be any more in that non-savings category. So they've got to take it out of there. They've got to create a fourth category now. So we're going to have non-savings, non-property, which is still at 20, 40, 45. Then we're going to have property at the new rates and savings and dividends. And the personal allowance will have a new ordering, and it will be ensure that it has to go from non-savings, non-property first to property to savings and dividends. So when the Chancellor or the Treasury went and put their proposals out to the OBR and people that they do, they obviously have to liaise with the software houses, the people who put the tax return software together. Naively, she was expecting it to be from April 26, and they said there's no way we're going to be able to code this in. We've got to do a whole lot of coding behind the scene. We're not going to get our software in time, so it's going to have to be April 27. So that is why we've got April 27 for property and not matching dividends next year. Now, with the increase in the property income tax rates to 22, 42, 47, some people might be looking to move their property portfolio into a company. So let's take a landlord. Let's call her Rachel from accounts. And let's assume she's got all the requisite permits that she needs to rent out her properties. She may want to transfer those properties into a company. Now, the benefits of doing this is two or three. One is the tax rate. So in a company, as long as your profits are less than 50,000, they're only going to pay 19% corporation tax. That's versus 22 or 42 if you're a high rate taxpayer. Secondly, there's no finance restriction in a company. So if a landlord finances their property portfolio with debt, so they've got mortgages, they can deduct some of that mortgage interest, but it's only restricted to the basic rate. So if you're a higher rate taxpayer and you're paying 42% income tax, you can only claim a deduction on 22% of your mortgage interest. In a company, that restriction doesn't apply. So some people like the idea of having their rental profits in a company as opposed to personally. And then the third option, or the third benefit, is to do with estate planning, to inheritance tax planning. It's easier to give away shares in a company than potentially a share in a property. So if you've got a company that's chopped up into 100 different shares or 1,000 different shares, you can give away some of those to the next generation, the children, the grandchildren, easier than you can with giving away 10% of an interest in a property, for example. So a lot of people use this in a family investment company type arrangement, FIC, where mum and dad might transfer their rental portfolio into the company and they'll hold one class of share. Their adult children can also be shareholders with a different class. And if they've got minor children or grandchildren, they can have a third class of share under like a trust arrangement. And what people use it for is they transfer the properties in. That current value, that current wealth is locked into the parents' share class. But then any future growth of those properties, rather than adding to mum and dad's estate and exacerbating the situation, you can set the rights of the company so that the future value of the company, the future value of those properties, it attaches to the children or maybe the grandchildren's shares and the value goes elsewhere. So it doesn't add to mum and dad's inheritance tax problem. So buy-to-let incorporations might become more popular as a result of putting up the property income tax rates. And then lastly on property, I'm assuming not many people or not many of our client base are going to be affected too much, but if you've got a high value residential property, we're going to have a council tax surcharge or mansion tax as people are going to kind of refer to it as. Slightly different to council tax, it's going to be levied on the owners and not the occupiers, so that's different to council tax, and the tax raised will go straight to central government. It doesn't go to local authorities, so again, slightly different to council tax. Okay, moving on to employment taxes. Last year, businesses were hit pretty hard, especially with the rise in employer national insurance. This budget, they got away lightly, so there wasn't really any changes or any increase in tax for businesses. National minimum wage is still going up. It's not going to be increasing as much as it did last year, but we still got there 21 and over, £12.71. So you're hiring a graduate straight from university. Minimum wage on a full-time there is still somewhere going to be in the region of £24,000 salary, something like that. So what was once cheap labour probably isn't going to be as cheap as it used to be. For those owning their own company and they want to make sure they're getting their stamp for national insurance purposes towards their state benefits, the new magic number from 26 to 27 is going to be £6,708. So that's the amount of salary that you need as a minimum to pay yourself in order to get credit for national insurance for that particular year. Now the rates of national insurance have not changed. They're part of those frozen thresholds for the next 3 years. So as an employee, you won't pay any employee national insurance if you have a salary of between 6,708 and the personal allowance, because you only pay employee insurance once your earnings are above 12,570, and that's aligned with the personal tax for income personal allowance. But the employer national insurance, there will be some employer national insurance. Last year, the government reduced the rate or reduced the threshold from when you start paying employers national insurance. They dropped that to 5,000. So you've got to pay yourself 6,708 in order to get your stamp. So there's going to be some employer national insurance, 256 quid. So this assumes a single shareholder director company who doesn't get access to the employment allowance. Probably one of the bigger changes, bigger announcements was to the pension salary sacrifice. This is not coming in until April 29, so they've got a few years yet before this kicks in. And the announcement was that if you're sacrificing salary in return for a pension contribution, then only the first £2,000 will be national insurance free. So anything above 2,000 will be subject to national insurance, and that's both employees and employers. It will still stay income tax free. So just to kind of illustrate this, the first column is a kind of standard. Somebody's awarded a cash bonus. High rate taxpayer, let's say they pay 40% income tax, they take 2% national insurance, so they're left after tax with 2,900. But if they said to their employer, actually, I'd like to sacrifice that 5,000 bonus, I'd like that as a pension contribution, please. That could go straight into their pension fund, national insurance free, income tax free. The full 5,000 goes into their pension fund, and the employee is £2,100 better off, and the employer is also better off because they don't pay their employer national insurance on the 5,000, so they get a saving 750. Some employers keep that for themselves. Some employers put that back into the pension pot of the employee to further add to their benefits. But from April 29, what that means is if you did the same sacrifice of the £5,000 bonus, only the first £2,000 would be free of national insurance. The £3,000 is then subject to both employees and employers' national insurance. Kind of key point to note that it's only normal, in inverted commas, normal pension contributions that is actually caught by this, that it isn't caught by this rather. So it's only salary sacrifice contributions above 2,000. If an employee makes a contribution into their pension fund or an employer is making employer pension contributions, nothing to do with salary sacrifice, these are still national insurance free. So alternatives are how you might be able to kind of plan around this. Potentially going forward, if you're offering a work set, or if you're going to increase wages to the workforce, if you say to them, instead of a 4% increase, you're going to have we're going to increase salary by 2% and we're going to make a 2% pension contribution, that would be fine. So if that 2% pension contribution exceeded 2,000, it doesn't matter because it's not part of a salary sacrifice arrangement. If you give the employees choice, if you say to them, would you want 4% growth in your wages, or do you want 2% and 2% your pension, you're giving them a choice. They can sacrifice that 2% into their pension fund, and they're in a salary sacrifice kind of arrangement, so that would be hit by the 2,000. But if you don't give your employees a choice, you just say, this is what we are doing, it falls outside of salary sacrifice, and those pension contributions will be employee and employer NIC free still. Just ending with a bit of a petty removal of a tax relief. So back in the pandemic, most people were working from home and were incurring increased household costs, electricity, gas, etc. And so employees could receive either a flat rate of £6 a week to cover those additional household expenses, or they could actually have the actual cost of what it did increase costs by. And normally an employer might have paid that straight to the employee, and that would be income tax and national insurance free. If an employer didn't pay that, the employee could still go and make a claim themselves and get income tax relief on that £6 a week. People obviously returned to the office, but some people have carried on keeping and claiming this £6 a week. And the Revenue or the Treasury found that in more than half the cases, these claims are ineligible. So basically, they're taking it away altogether for employee claimed. If the employer is still paying £6 a week, that's fine, but it's just where the employer isn't and the employee's making their own personal claim. That is no longer from April 26. Capital gains tax then. The main announcement was the restriction on the capital gains tax relief for owners of trading companies selling their company into an employee ownership trust. Now this took effect from budget day, so I think it's one of the only proposals that had immediate effect. So the employee ownership trust is the kind of John Lewis model, although it's not quite exactly the same. But this is where a trading company owner sells their shares to an employee ownership trust, and until budget day, any capital gain was completely tax-free, whereas going forward, only half is tax-free, 50% will remain taxable. And even though we're talking about the sale of trading company shares, that 50% that's subject to CGT, that doesn't get business asset disposal relief, we used to call entrepreneurs relief. So an EOT was as part of an exit strategy where there are different options available. So with an EOT, which is still available, a business owner, what they would do is rather than selling their company out to a competitor, they could set up a trust fund for the benefit of their employees, and they could sell their company to the trust fund. And that would be, until budget day, completely tax-free. Going forward, 50% exempt, and the remainder 50% would be taxed at 24%. So if you've got kind of like a culture that you want to preserve and you don't want to see that getting stripped away, you've got a strong management team, business owners can sell their trading company to an EOT, half exempt, half at 24%. The trust obviously doesn't have any cash to start with, so if the company's got some cash, it passes it to the trust, and the trust then passes it to the business owner. So they're likely to get their sale proceeds over a number of years as the company continues to make profits. We talked about it before. Succession is probably one of the most simplest methods of exiting a business. So if you've got family and you might just want to pass that down to the next generation, there's still capital gains tax reliefs available on the gift down to the next generation, where there's no capital gains tax on passing that business down. If you want to receive some cash out, it is possible to receive cash out as well, and sometimes without even triggering any capital gains tax. Then you've got things like management buyouts, similar to the employee ownership trust. So rather than selling it to a trust for the benefit of all employees, you sell the company to a select management team. Cheap buy-in price for them because it's matched with the associated debt due back to the business owner. And again, it's reliant on the business still making profits to kind of pay out that sale price. They will get something on day one, but usually there's a deferred element to their sale proceeds. If you sell to a management buyout structure, business asset disposal relief is still available. And then finally, a trade sale, going out to the market, selling to a competitor. That will get you probably full top dollar, and you're probably going to get your proceeds pretty much all on day one, potentially with a little bit deferred. And again, business asset disposal relief available. So EOTs becoming a lot more popular, but they just had their capital gains tax relief curtailed. So in terms of cars, we hear there's going to be a new charge for electric vehicles and plug-in hybrids, which is to replace the lost fuel duty. The equivalent petrol diesel cars fill up at the pump, included in that price is the fuel duty, whereas when EVs and plug-in hybrids fill up at home, on the electricity, there's obviously no fuel duty. So there's going to be a 3p for electric car charge and 1.5p for plug-in hybrids, and that's going to be based on a kind of estimated mileage situation. So each year when they renew car tax, there'll be a facility to plug in the estimated mileage for the year ahead, and they'll pay that charge on that basis. And then presumably in the following year when they're renewing their car tax again, they will have to put in their actual mileage, and it will be over or under, and there'll be a mop-up payment presumably. Sticking with electric vehicles, if a business purchases an electric vehicle, as long as it's new and unused, it can write off the full cost of that electric vehicle against tax. It's been extended again, that 100% first year allowance, but rather than the usual 2 years extension, they've only done it for 1 year this time. Now, might be reading something into that, but you look at the changes that EVs have had recently. They used to be excluded from road tax, they're not anymore. Now we're getting the charge to replace the fuel duty. This is now getting the 100% allowance only for 1 further year. So I'm just wondering whether the landscape towards EVs is changing, whether they're going to start taxing it more and potentially remove this first year allowance. So this is in there till the end of March 27. It may well get renewed again, but for now it's just 1 year extension. So sticking with the capital allowances theme, from April next year, when a company incurs capital expenditure, they get to write some of that cost off against tax. If it hasn't been written off in full, it then gets written down each year, currently at a rate of 18%, but that's being cut to 14%. And that's on the main rate items of capital expenditure. And then kind of at the same time or slightly earlier in January of next year, they're kind of replacing, or they're introducing rather, a new 40% first year allowance for main pool items. But businesses already have the annual investment allowance, so that's that £1 million that they can spend and write off the full cost of capital expenditure against tax. And then companies have what they call the full expensing, where effectively the same, but they're not limited to £1 million. So on their main rate items, it doesn't matter if it's 1 million or 10 million, they can write off the full cost against tax. So how useful this new 40% allowance is going to be, it's really only aimed at businesses that hire out assets. So, a typical plant hire company, those companies previously who purchase assets and then to lease out, there was a restriction in, for example, full expensing, where those assets wouldn't get capital allowance. So this new first-year allowance is being brought in to help leasing companies and also unincorporated, so sole traders, partnerships. They don't get access to that unlimited full expensing. That's only companies, but this new 40% first-year allowance will go some way to replace that. Pensions, other than the salary sacrifice pension contributions, there were no other real changes to pensions. So normal pension contributions are still national insurance free for both employee and employer. The annual allowance, the amount that you can put into a pension fund and receive tax relief, that's still there at 60,000. The tax-free lump sum, there was potentially some rumours that they might remove that or do something with that. That has remained as it is, albeit sadly they're still ploughing ahead and going to bring pensions in to the IHT net from April 27. There was no changes to backtrack on that one, unfortunately. Now that you've got the tax-free lump sum is still there, what some people are doing is drawing from their pension tax-free, and they're taking that tax-free lump sum drawing and then giving that away and surviving 7 years, and that will be completely outside of their estate. Other people are not necessarily taking a big lump sum, but they're drawing that on a regular basis, and they're taking that as income. And doing that so under the tax-free portion of their pension fund. And then they're giving away the regular income stream rather than giving away the capital. And the benefit of that is if you're giving away surplus income, you don't have to wait 7 years from an inheritance tax point of view. Surplus income that you choose to give away is completely IHT exempt from day one. So some people are drawing from their pension and just funneling the annual income away to family. Two amendments to the proposals that were announced last year. One is that death and service benefits from registered pension schemes, they will be excluded, so they won't be part of this new 40% IHT from April 27. And then in terms of who is responsible for reporting and paying the IHT, they were talking about the pension scheme administrators doing that. Following consultation, that's now going to be the personal representatives, the executors. They're going to be responsible for reporting and paying the IHT, but they can direct the pension scheme to withhold up to half of the taxable benefits for a period of 15 months and make the pension scheme pay out the IHT that's due before they release the balance of the pension fund to the beneficiaries. So just to finish on a couple of share investment announcements. So there was some welcome news on the EMI share option scheme, so the enterprise management incentives. So if you've got some key employees that you want to retain in the business or incentivize, giving them some equity in the company is potentially a good way of doing so. And that basically says to them, look, the current share price is £5. We'll give you the option to buy some shares in the future. The price goes to £8 in the future, but they only have to pay that original £5. So there's a bit of a discount there, and that discount is tax and national insurance free. So the announcement that they made was that it's going to be, the scheme is going to be open to more businesses. So the amount of options that a company can grant is going to double to 6 million. The size of the company that can grant EMI options, restricted currently, if you've got gross assets at 30 million, it's now going to be 120 million. So it's quite a big enterprise that's going to be able to grant EMI options. And again, the number of employees in the period which the options have to be exercised are increasing too. And the same with the enterprise investment scheme and the venture capital trusts, where companies want to raise finance. The incentive for investors to do so is that they'll get some tax relief back. So you invest 10,000, you would get 30% income tax, so you get £3,000 back. So your net investment's only 7,000. They too are increasing the bandings and the limits so that more companies will be eligible to raise finance under EIS. Slight disappointment is that the income tax rate for the VCTs is dropping from 30 to 20. The EIS income tax will remain at 30%. Any movie fans in the audience? Let's see if someone can get this one. Anyone? Cliffhanger, yes. I'm going to leave you on a cliffhanger this morning. Buried away at 4.149 of the Red Book was this kind of ominous statement which says, from April 29, the government's going to require income tax self-assessment taxpayers with PAYE income to pay more of their self-assessment liabilities in year. Now, I've not been able to find any more information on this, so I don't know exactly what that means. It says that they're going to consult in early 2026, but potentially that might mean we're having to pay more tax, or certain people might have to pay more tax earlier. I don't know. That's me done this morning. Thank you very much for listening. I'm going to pass you back to Helen, who's going to ask for questions either in the audience or via Slido.